right. Good morning, everybody. Happy Thursday, all you magnificent melonheads. Today is August 3rd, 2023. The market sell-off continues this morning. The ruckus that started with the Fitch downgrade of the U.S. credit rating 2 days ago. And I love that word, ruckus. Every time I hear somebody say ruckus, I think to myself, could you describe the ruckus? What movie? Let me know down in the comments if you know that movie. Quote. So the ruckus that has started with the downgrade of the Fitch credit rating continues. We've got yields moving higher. Yields broke out from a very important level last night. We actually retested that level last night while we were all sleeping. Shout out to my moderator, Mish, who does not miss a beat in these markets. Thank you, Mish, for all your services to the channel, sir, along with my other blue wrenches out there. Yields are moving higher this morning. We've got worries about government borrowing, worries and panic started over the Fitch downgrade, but also worries about what might the Bank of Japan do. Remember, a lot of this started with the tweak to the BOJ's yield curve control policy. That was last week on last Wednesday when they announced that change. And I've got a guest coming on next week to talk about the yen carry trade. There's a lot riding on those Japanese interest rates and on that Forex rate between the US dollar and the yen. And that actually could have an effect on your Apple stock or your Amazon stock. Believe it or not, the yen matters to that. We're going to get more into that next week. Also, after the close today, we've got Apple and Amazon are both reporting earnings. So it's only about, $3.5, $4.5, $5, $6, $7 trillion worth of market cap between those two companies. So regardless of what happens after hours today, I think we're going to see big moves one way or another. I really don't know what to expect. Amazon is going to be talking about AI. Apple is going to be talking about AI. I'm not sure if that one-trick pony is going to fly anymore. We've also got Amazon's going to probably post some pretty good numbers related to their Rivian stock because Amazon is a big shareholder in Rivian, and Rivian stock has done fantastic as of late. So that could give a little bit of a boost to Amazon. But you know what? We've also seen some pretty lousy cloud computing numbers from Microsoft and from Salesforce. So that could hurt Amazon. And of course, remember that yellow trucking story. Stuff is not moving. And let's not forget Amazon's core business, warehouses full of boxes shipping around the country. So I'm not sure that's going to keep an eye on Amazon. Amazon will be telling. And Apple, we've also got a little bit of worries about China and the health of the Chinese consumer. Right? A couple of percentage point change in the spending habits of Chinese consumers can have an outsized impact on Apple. So we'll keep an eye on that. A lot of the chip companies have not been doing very well. Well, who do those chip companies sell chips to? They sell them to Apple. Elsewhere, we've had the Bank of England announce a 25 basis point rate hike last night. The tightening cycle continues. Bill Ackman is in the news, and I cringe every time I say the name Bill Ackman. We'll talk about him. And oil markets, what on God's green earth is happening in oil markets? Major revisions to the data. They started yesterday. They started 2 days ago. They continued yesterday. They're playing games with the oil market. They delayed the refilling of the Strategic Petroleum Reserve again. And of course, as I warned in my Patreon Zoom call yesterday, shout out to my Patreon supporters. Thank you for everything you do for the channel. But I warned yesterday in my Patreon Zoom call that they are going to evoke the Saudis' wrath with these shenanigans, this chicanery, all of this duplicitous dealings going on with oil data in the Strategic Petroleum Reserve. And that is exactly what's happening this morning. The Saudis are pissed. Why? Well, they sell oils, and we're playing games with the oil's datas and all the oil's prices. And, well, Saudis are saying, you're not getting any more oil. How you like me now? Guys, the stink of politics in economic data is such an existential risk. I can't warn enough about this. Certain things like science, like economic data, certain things need to rise above politics. And politics has this infectious, odorous stink about it. And once the filthy fingers of politics gets into your jello, you can't get those marks off of it. And unfortunately, that's what's happening in oil markets right now. So with that, let's shrink my big melon of a head. And as we're shrinking my big melon of a head, won't you expand that big melon of a like button for the YouTube algorithm? It really helps me out. So give me those big thumbs up. And if you're new here, won't you please subscribe to the channel while you're here? It really does help me out. CNN Fear Greed Index It had dropped into the 50s momentarily yesterday, but we're back now in the high 70s, pushing into extreme greed territory once again, sitting at 74. The S&P, though, is still heading lower, down another 23 points this morning. That's 0.5%, 4,490. That's on top of yesterday's sell-off. The Dow is down another 72 or 0.2% this morning, 35,209 for the Dow. And the NASDAQ is leading the way lower once again, down a full 0.5 point. Another 69, almost 70. There's 70 points for the NASDAQ, down 13,900. That's on top of the 300 points it lost yesterday. Bloodbath in the high-risk tech stocks yesterday. Let's look at the NASDAQ here real quick. This is going back to about the beginning of the year, and this is something I had been warning about, an RSI divergence in the NASDAQ. RSI is relative strength. That's a measure of the momentum that a stock has. And you'll notice recently these highs, the NASDAQ index has been making higher highs, much to my own bewilderment. It's continued to make these higher highs lately, even though as it's made lower highs in relative strength. That means even though the prices were flying, this thing was rapidly running out of momentum. Well, something else happened yesterday. We actually got a lower low in the RSI. So that, in my book, that confirms this RSI divergence and tells me this is actually a breakdown in progress. Now, look, Amazon and Apple could report great earnings after the bell today. It could shock the world. Everything could be great, and we could go onward and upward to new highs in the NASDAQ. It's entirely possible. We have seen stranger, more bewildering things in the last few weeks alone. All right, so it would not be at all surprising. But absent that, I think the NASDAQ's heading lower here. So after the bell today, pay close attention. Things are going to move after the bell today. Looking over at the U.S. dollar, that is up again this morning, another 7 basis points, 102.66 as the dollar continues to strengthen. Remember, the dollar is the denominator in the equation of price, right? If the price per share, if the dollar value is going up, that means the dollar value of stocks is going down. This is downward pressure on stocks. And let's just look at what the DXY chart has done. We were looking like we were going to break down 2 weeks ago. We were talking about after those jobs reports in July, as the dollar was breaking down, everybody was talking about Fed pivot, the end of inflation, that everything was going to be so great. Well, man, we retested that line and right back up we came. And now the dollar's heading higher. It retook the 50-day moving average yesterday. Look at that right there, back above the 50-day moving average. The next test of the DXY is going to be this 103.4 level here. That was the prior high. And after that, we've got the 200-day moving average coming up. So the Dixie right now still looks like it's heading higher. Looking over at the bond market, look at the long end of the yield curve today. Moving big. The 30 years up 13 basis points, 4.29 on the 30-year Treasury. The all-important 10-year Treasury, 4.18, up another 11 basis points this morning. That's a big one, guys. That's important, that 10-year Treasury going higher. I'm sorry, let me remind you, the yield's going higher. That is the price, the value of those bonds going lower. Always keep in mind that inverse relationship. The 2-year at 4.9, and the 1 month is still held in place at 5.37. And let's look at the 10-year Treasury chart. This is what I drew yesterday, that cup and handle pattern, guys, and there it is. We actually came down and retested this level again last night, bounced right off of it, and now we're heading higher. This is important, guys. The 10-year Treasury, this affects your mortgage rates. This affects your car loans. This affects your credit cards. This thing moving higher. This is so bad for America's businesses, especially those zombie companies that are dependent on debt for their survival. As this chart moves higher, that debt gets more expensive. The payment costs, the interest expense of servicing that debt gets more expensive. This chart going up means more companies going bankrupt, means more people getting their houses foreclosed on or getting their cars repossessed. Now, home foreclosures is not yet a thing in this economy. The housing market is still doing okay, even though it's very illiquid. But things like car repos, they're already sky high. So keep an eye on that 10-year Treasury. This is the one that's really driving markets lower right now. And let's talk about this one. We had Thomas Barkin, who's the head of the Richmond Fed, was speaking today, and I just love this quote. Fed's efforts to address inflation have pushed several industries into mini recessions. Oh, mini recessions, not an actual recession. Certainly not. Don't make me change the definitions or anything. No, mini recessions. And I got to send a shout out to Joel Moore on Twitter, who posted this one yesterday, and I almost spit out my wake up juice when I saw this. He says, I love this meme. It's not a recession unless it comes from the recession region of France. Otherwise, it's just sparkling economic pain. I love this meme. This guy, yeah, it's not a recession. We'll just change the definition. We'll point to this one area. There's mini recessions all over the place, but it's not an actual recession. Not as long as we can, lie about one specific data point and still make things look good. Shout out to Joel Moore on Twitter. Thanks for that. Looking over at commodities, we've got gold is not liking these higher interest rates this morning. Down only $1.75, but still down at $1,973. Silver's down another 9 cents today, or 0.49% at $23.78. It's been a rough week for my favorite of the shinies. Although silver stackers are used to these price smashes, and it is nothing new. Crude oil is at $80. It's up 57 cents this morning for WTI crude, still above that 80. Let's talk about oil, by the way. But first, let's talk about the main story here. Treasury rout unnerves traders as stocks retreat. This is the big story today. This is what's really driving markets. And the caveat that Apple and Amazon due to report earnings later today. If anything can break this sell-off, it will be Apple and Amazon earnings. Those are just massive, massive companies. All of this big move in the stock market has been just a couple of names, and Apple and Amazon are two of those names, along with Microsoft, Google, Meta, NVIDIA. These are the stocks that really drive the indices. But I want to talk specifically about this quote here, the U.S. downgrade from Fitch the other day. It doesn't have any direct impact on markets, but what's happened is there's been a lot of concurrent news. Fowler at the UBS said, Treasury supply is going to pick up. That's Janet Yellen with all of her ridiculous amount of bond issuance, something I talked about in my last few streams. And the Bank of Japan's policy change has also removed the floor on bonds, and that's led to rising yields. See, those low bonds at Japan, that has enabled that yen carry trade where you can just borrow yen over in Japan for almost nothing, convert them over to dollars, and then buy U.S. bonds in order to make a higher interest rate on the U.S. bonds than you're paying an interest rate on the yen you borrowed. But as the Japanese let their interest rates rise, the yen trade, that yen carry trade is getting less profitable. And so it's removing the floor on bonds. This is giving bonds room to fall as the arbitrage opportunity from borrowing yen and sending it over into the U.S. bond market, that's going away. So that's really what's got the markets worried right now. And stocks move up and down based on what the bond market does. Forget what Jim Cramer says about AI, guys. The bond market is what drives these things. And speaking of the bond market, the Bank of England raises key interest rate by a 0.25 percentage point. The central bank says it may raise rates again. That's right, Andrew Bailey, the guy who told you, if you're in the UK, that you just need to accept a lower wage. You need to stop asking for a raise to offset the rising cost of living. No, you, the working class stiff, you're the reason why prices are going up because you want to make more money. Talk about a let 'em eat cake moment from Andrew Bailey over at the Bank of England the other day. But talk about out of touch. And we're going to gripe a little bit about the financial press this morning, guys. This one here, like the U.S., the UK's economy has proved surprisingly resilient over the past year, defying expectations that it would slip into a recession. And I'm zeroing in on this line because talk about out of touch, that the UK's economy has proved surprisingly resilient. Do you guys remember back in October, November, the entire UK pension system almost failed in the middle of the night because their interest rates rose so fast and their pensions were caught offsides with bets on interest rates. The whole country almost lost their retirement like that. The Bank of England had to turn on the money printers in the middle of the night and buy up all of these UK gilts, their 10-year bonds, to try to prevent the pension system from going belly up. That happened a few months ago. And here's this article in the Wall Street Journal saying the UK's economy has proved surprisingly resilient. And this is why I'm like the only bearish voice in this ocean of FOMO nonsense that's going on out there. When these stories happen, these unbelievably profound risks to the the well-being of the common person, and the press just sweeps them under the rug, and they're like, how about that NVIDIA stock, though? How about that artificial intelligence? Never mind the fact that your pension almost died. How about those tech stocks, though? So this is just one of my big gripes about the mainstream financial press is they gloss over the real risks, and they just distract you with these shiny little red herrings, and the real risk lies elsewhere. Now let's talk about what's going on in oil, because talk about shenanigans. I warned yesterday about what the American Petroleum Institute had reported in their inventory numbers. That shocking 15.4 million barrel inventory draw when they were only expecting 900,000. And I said, watch out, because later on today, this was yesterday, the Energy Information Administration, the EIA, they were going to report their oil numbers. And guys, we got the same thing. U.S. crude oil inventories went down by 17 million barrels. It was even worse, the EIA data. 17 million barrels in the last week of July, the biggest draw on record. We have never drawn down oil inventory faster, and way more than the market was expecting, of 1.367 million. And look at this inventory draw. They were expecting 1, and they got 17. And, you know, we zoom out on a max chart here. Here it is. Here's that data point. It is the lowest draw in the history of this data, going all the way back to 1983. We have never seen such a big drawdown in oil inventory. 17 million barrels of oil unexpectedly disappeared in 1 week. That's like 2.5 million barrels a day of additional oil consumption. Do you think the U.S. actually burned that much oil all of a sudden in 1 week? Or do you think that they've been fudging the numbers on the oil inventory data? Uh-oh, here comes the tinfoil hat. Here we go. Merchandising. Or do you think that they've been fudging the oil numbers, and they finally had the cumulative fudge factor has gotten so big that they're just like, blah, here's this big data dump. We're going to tell the truth all at once. The compounded error of week after week of fudging the data. And here it all is in this one correction on a day when maybe they're hoping nobody notices. But Javier Blas noticed. He noticed a few days ago. This is Javier Blas. He is the head commodities expert at Bloomberg. We talked about this on my Patreon Zoom yesterday, and I was warning about this story. Oil market, massive revision to U.S. oil demand and supply data. The EIA pegged total demand at 20.776 million barrels per day in May using the monthly data. That was up 973,000 barrels per day. So almost a million barrel per day increase in the May data, but they buried it. They only revised the monthly data. They didn't change the weekly data. So you've got this massive change to the way they're reporting oil consumption. And of course, the error is always in a direction that sends oil prices lower. The errors never go in the other direction. They always go in one direction. And that's how you know that there's some kind of tinfoil hat time, some kind of political buffoonery going on here. Because the error is always in a direction that is to the benefit of a political class that wants lower oil prices to keep their poll numbers higher. And simultaneously, this story broke yesterday. The U.S. withdraws their offer to buy 6 million barrels of oil for the SPR. They're going to delay the refilling of the Strategic Petroleum Reserve. And remember, guys, the only reason oil prices went down last year was because of an unprecedented release of our emergency stockpile of oil. 180 million barrels of oil was dumped in the open market to suppress oil prices in order to drive somebody's political numbers higher. Now they're lying about the oil inventory. And of course, the lie got so big that they had to tell the truth once to correct the data. Now they're not going to refill the SPR. Now, guys, what do you think? Put yourself in the position of a Saudi crown prince. All right, try, because the Saudi crown prince, he is a murderer. Remember, he murdered an American journalist. So, okay, you're this murdering crown prince, and the Americans are playing games with their oil data, suppressing oil prices, which affects your income. What do you think this murderous crown prince is going to do? Well, he's going to do this. And this is what I was warning about in Patreon yesterday in my Zoom call, and it didn't take 12 hours for it to happen. Saudi Arabia to extend its voluntary production cut of 1 million barrels per day through September. And they're saying that this voluntary production cut can be extended or even deepened. Every time we fail to refill the strategic petroleum reserve, the Saudis get pissed and they cut production even more, driving oil prices higher. The Biden administration doesn't get it. The Saudis are not going to let oil go into the low 60s. They're not going to let it happen. Every time the price heads lower, they're going to cut production. You're going to have to pay up to refill the SPR. But, why do that when you can just ignore the problem and hand it off to your successor? So that's what's going on in oil markets today. And again, this data is too important, guys. There's too much money riding on this. They need to start telling the truth in this economic data. Certain things need to rise above politics, and this is one of them. Shout out to Gavin on Twitter for this data. Now, the last thing I want to gripe about this morning is this story. All right, and this is another thing. This is arguably why I started this channel. One of the reasons I did is this story. Billionaire investor Ackman says he's shorting 30-year treasuries. All right, I'm not going to read this story. I'm not going to tell you what Bill Ackman is saying. All right, there's Bill Ackman. Get a good look at his sad face. Oh, poor Bill. Poor Bill. Don't be like Bill. Don't you feel sorry for Bill with his sympathetic look there. Let's talk a little bit about Bill and about the financial press that still has him on the air. I want to take you back to March 18th of 2020. And Bill Ackman went on CNBC and he said, hell is coming. And he was talking about the lockdowns and the shutdowns, and he's phoning it in. And as he's phoning in this interview on CNBC, he's talking about how worried he is that the disease is going to kill his father. And he was fighting back tears and he was sounding choked up. He was so worried about his father. And then he said, Hilton stock is going to zero. The markets puked on this interview. You can watch the needle on the markets. As he was talking, the market just went vertical down and it triggered the circuit breakers and they shut down the stock market. He went on TV and he scared people. Now, what Bill Ackman did not tell you is that as he was doing that, his hedge fund was buying Hilton stock hand over fist. All those fake tears he was choking back about his father and the disease I can't say, I don't want to get in trouble. He was taking the other side of the trade. He was scaring people into dumping their stocks so he could buy them up on the cheap. Ackman turned a net profit of $2.6 billion on that March 18th interview on CNBC. He used those proceeds to wager that existing Pershing bets, including hotel operator Hilton Worldwide, would rebound. So he went on TV and he scared people into selling their Hilton stock so that he could buy it. And he levered up. He bought it all on leverage. And he turned $27 million into $2.6 billion, a return of more than 10,000% by advertising the other side of his trades on CNBC. And you know what? CNBC still has him on the air week in and week out. What does that tell you about what CNBC thinks of you? If Bill Ackman can go on the air and try to scare you, and when I say you, I don't mean you specifically, I mean you, the public. When CNBC lets this billionaire come on and scare you into selling a stock so he can buy it and make himself $2.6 billion richer, no investigations by the SEC, no prosecution, they barely even covered it, and they still have this guy back on the air. What does that tell you about CNBC's opinion of your intelligence or about the ethics of the people who bring this guy back on the air? And this is why I just rail against the traditional financial press all the time. Now, look, guys, I get calls wrong. I get calls wrong a lot, right? Case in point, most recently, the PKG trade that I talked about, all right? I took a bath on that trade. I lost a ton of money on that one. All right, but when I talk about a trade on my live stream, I'm talking about what I'm doing with my money, and then I'm telling you, don't just do what you hear some YouTube guy tell you, do your own DD and your own research. I'm just telling you what I do with my money. I might be wrong, I might be right, I got that one wrong. But I didn't go on the air and tell you to buy PKG while I was taking the other side of that trade. I wasn't using you as exit liquidity. I got it wrong, but I wasn't being a devious a-hole like Bill Ackman was on CNBC. And this is what I can't stand about the financial press, is they still have this guy on TV. All the people who promoted FTX are still being invited back onto TV. All the people who got rich off of the people who lost billions in FTX are still on the air on these channels. They're still invited time and time again. And this is what I can't stand about the traditional finance press. And that's why I'm not going to read you the article about Bill Ackman and whatever he thinks of the 30-year treasuries, because you never know which side of his face Bill Ackman is talking out of. Is he really talking about what his bets are, or is he secretly taking the other side of the bet and he wants you to bid up the price? There's no way of knowing, and CNBC knows he does this, and they have him on the air anyway. Last but not least, guys, keep an eye out for Apple and Amazon results. Again, that's a big one today. That's going to steer markets for the next day or two. It's going to be a big move one way or another. I don't know which way it's going to go. You guys know me. I'm generally a bearish guy, but we've been pretty surprised as of late by what Apple and Amazon and stocks of their like have done, so keep an eye on that one. That all starts after the closing bell at 4 o'clock Eastern time. And guys, I want to say thank you so much for smashing that like button and subscribing to the channel. Also, thank you to my Patreon supporters. I had a great time talking to you guys yesterday on our Zoom call. I got links down below to all that good stuff. And I got to say, hi, Mom, hi, Dad. I love you guys. Till next time, live small and dream big.